Good morning, everyone.
Good morning.
Welcome to the New York City Retirement Systems Common Investment Meeting for September 19th, 2019. We are going to begin by calling the rolls. So let's start with fire. Mr. Dunn.
Good morning, John.
Good morning.
For Mayor de Blasio.
Cynthia Collins, designee for Mayor Bill de Blasio.
Okay, for Comptroller Scott Stringer.
John Dorsa for Comptroller Scott Stringer.
For the UFA, Mr. Gerard Fitzgerald,
Leroy McGinnis with Gerard's proxy.
Mr. Leroy McGinnis,
Present.
Mr. Edward Brown,
Present.
Mr. John Kelly,
Eddie Brown with John Kelly's proxy.
Mr. John Young.
John Young, Pete DeVita's proxy.
Okay, so for the UFOA, Jack Kelty, Liam Guilfoyle, Paul Mannix. Hi, Rich. And for Commissioner Daniel Nigro? We have a quorum. Oh, I'm sorry, Department of Finance. I skipped that. Jacques Jihan, sorry.
Phil Dukes for Commissioner Jihan.
We have a quorum. Thanks, John.
Okay, folks, I just want you to speak into the mics so our scribe can get your names properly. Okay? What's a scribe? A scribe. It's an old-style transcriptionist back in the day. Okay, don't write that down. Okay. Okay, continuing. Police, Mr. Holleran.
Good morning. Representing the PBA,
Joe Alejandro.
Juan Zubizarreta.
DEA, SBA, LBA,
Brilliant designee for Lutarco.
CEA,
Johnny Ramirez, proxy for Roy Richter.
representing the mayor,
Shuman Ray.
Commissioner of Finance,
Cynthia Collins for Commissioner of Finance.
Comptroller's Office,
John Dorsa, designee for Comptroller Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, designee for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. Moving next to teachers, Ms. Riley.
John Adler,
Yes, I am here.
Thomas Brown, Natalie Green Giles, David Kazansky, Russell Buckley,
Here.
Deborah Penny, Susanna Vickers.
Ms. Vickers is on her way. In her absence, John Dorsa is here from the Comptroller's office.
So we have a quorum.
Thank you, Patricia. And NICERS, Ms. Winery,
Chair, Mayor's Office,
John Adler.
Comptroller's Office,
David Jetter for Comptroller Scott Stringer.
Public Advocate's Office, Borough President, Manhattan,
Aldrin Bonilla on behalf of Manhattan Borough President Gail Brewer.
Borough President, Brooklyn, Borough President, Bronx, Borough President, Queens, Borough President, Staten Island,
Isaac Gorodetsky for Borough President James Otto.
International Brotherhood of Teamsters,
Here he comes.
Lawrence Bosley for President Greg Floyd.
Transport Workers Union,
Dave Katzman for TW Local 100 President Tony Otano.
District Council 37.
Present.
We have a quorum.
That was Henry Garrido. Okay, thank you, Melanie. And Burrs, Mr. Rich?
Morning, Mr. Adler. We're represented today by Russell Buckley, trustee. We do not have a quorum. Any business we can adjudicate October 22nd at our next board meeting. Thank you.
Thank you, Sandy. Okay, all present and accounted for. Let me just go over our agenda. We'll be doing public session with quarterly reporting, and then we'll be entering executive session, and we'll take it from there. So without further ado, I will turn it over to Mr. Donier and for the quarterly reporting.
Thank you, John. And we will begin, as usual, in the quarterly reporting months with a market overview from Mike Haddad, our Deputy CIO, and he will also comment on the strategic asset allocation process with the systems consultants.
Good morning. As Alex said, I'm going to talk about Q2 markets performance as well as asset allocation. And within asset allocation, I'm going to touch on both your current asset allocation and spend some time on strategic asset allocation and the process that your consultants and us are going through in quite detail. So quickly jumping into market returns for Q2, this should be a familiar slide to all the trustees. I would draw your attention to the third and fourth column, third column being second quarter results, and the fourth column being the fiscal year results. And again, as a reminder, these are the market indices, not your exact portfolios, although your portfolios do resemble these, and Alex will go into much greater detail in your portfolio performance. So a few observations is one, for both Q2 and the fiscal year ending in June, very strong performance across all asset classes. And this comes in the wake of, if you remember some of the market turmoil we've had in the past fiscal year, the sell-off in equity markets and interest rates in November and December. And then we had a sell-off in May this year in equity markets when the president was tweeting about tariffs during early part of that month. Second observation is the very strong performance in U.S. equities, again, both in the quarter and the fiscal year. And that strong performance is both outright, that's against international equities, and that's also against your consultant's expectation. So if you look at the far right-hand column, the expectation as of 2016 was for something, and this is the average of your 5 consultants, was a little under 8%. And on all time frames, you can see how U.S. equities have outperformed that expectations. And that's an important thing to remember as we talk about our new strategic asset allocation. The third observation on this page is the very strong performance in long-duration treasuries. You can see in the quarter, they had a big return as yields fell almost 27 basis points in the quarter, and the very strong return in the fiscal year as yields fell almost 50 basis points. As a reminder, if we go one column over, you'll see the return is just barely in excess of 1%. And you know what that means is over the previous 2 years, yields were up quite a bit, and the return on that asset class was actually negative. The fourth observation I would make from this slide is the positive correlation between equities and fixed income across all time spans. And again, I'm going to refer to that again in the strategic asset allocation. So what changed? What changed in Q2 and why did we have such strong performance? First and foremost is slowing across the globe. China and U.S. both slowed in the second quarter, and there's likely recessions in Germany, France, and U.K., all for unique reasons, but nonetheless, that is probably underway. And the second that I alluded to earlier was the trade war intensification, and that really came on a weekend tweet by our president about increasing tariffs, which was against his advisor's advice, but nonetheless, he did so, and I think we've all been following that in the press as it ebbs and flows. Most importantly, what really changed was interest rates. We talked last quarter about the Fed's dovish pivot. That pivot has continued. And what I've listed on this slide are a handful of the key statements across either speeches or policy statements by the Fed and the ECB. And the result of that has been a meaningful decrease in interest rates across the globe. This slide attempts to capture how the market's expectations evolved in the first 2 quarters of this year with regards to policy rates. So if you look at the top 2 lines, the blue line is the expectations of all global central banks. The orange line is the dotted orange line is X outs the U.S. And prior to at the end of December, those top 2 lines represent the expectations of markets of what short rates we're going to do across the globe. And you can see there's a gradual slope up. What the shaded part of that shows is where expectations for global policy rates were at the end of Q2. And you can see the dramatic shift in market expectations of rates. And again, expectations and the easings that have taken place this week, those have all taken place this week, but you can see the markets were anticipating something like that. And that also had a big impact on long interest rates. So what we're showing you on this slide is by country where 10-year yields stood at the end of June. And the third column is the change in 10-year notes in the second quarter. The green in the second column indicates positive interest rates, the red negative interest rates. There's quite a few negative interest rates around the world these days. And the other observation would be the drop in yields across the globe and the meaningful drop in yields across the globe. I don't have on the top of my head every country, all 180 of them, but my best guess would be, other than Venezuela and Argentina, rates were down in almost every country. Let me pause there before I go into asset allocation. If there's any questions or comments about either Q2 or fiscal year.
Okay, looks good.
Current asset allocation. So in the second quarter, there was only a small amount of rebalancing activity. We extended duration, a very small amount of duration extension in your Treasury portfolio. Our portfolio concerns remain the same: slowing global growth, geopolitical risks, and those are expressed anything from Brexit to China-U.S., the upcoming U.S. election, the multiple events, uncertainties in the Middle East, as well as the central bank easing cycle is well underway. So the bubble graphs, which are on the next 3 pages, are not very different from what you saw a quarter ago. And just a reminder of the tactical tilts in your portfolio: we're slightly underweight U.S. equities, we're slightly underweight investment grade, we're slightly underweight mortgages, and overweight treasuries. So I'm just going to go through these slides relatively quickly. Very little new information on these. What I do want to spend a little time is on your treasury portfolio. So I don't think we, BAM, have done I think we can improve on how we explain the duration in your core bond portfolio. And on this slide, we are attempting to do so. So I would draw your attention to the bottom 2 rows. And by system across the x-axis shows your duration as of the end of Q1 and your duration at the end of Q2. And so the durations increased slightly over that quarter period, and that's due to a little bit of the rebalancing, as well as anytime there's cash needs in your portfolio, be it for capital calls, be it for paying out benefits. The place we're overweight is treasuries, and that's in the very front of the bond market. So when we take that money out of the portfolio to pay for your needs, that lengthens your duration just a little tiny bit. The other comment I want to make on duration: so we are underweight your targets, and we have been wrong on that. So let me spend a second on that. As I said earlier, the 30-year is down almost 27 basis points in Q2, and when we extended duration on your behalf, we extended into the 12-year maturity, not into the 30-year maturity. Why did we do that? We've had the opinions that the 10s, 30s yield curve is going to steepen more than rates are going to fall. So what happened in Q2? 30-year rates were down 27 basis points. That yield curve steepened by 14. For us to be right, the curve has to steepen twice as much as yields fall. And while we got the direction of the curve right, we didn't get the magnitude of it right. So I don't think that story's played out yet, but I just, in an attempt to be more transparent as to where you are in your duration and why, that's what this slide is all about.
What are the percentages? What do they refer to?
So back to 16, we, everyone agreed upon a duration extension within your Treasury portfolio. I'm sorry, your core bond portfolio executed through Treasuries. So if we took the duration where we were and where we needed to get to, that percentage represents how far along that path we are.
So in other words, when you say, like looking at teachers, for example, that you're saying that the 10.24 is 71% of the way between 6.19 and 11.
Exactly.
Sorry.
The volume all around is not high enough.
Can we turn the volume up on the speakers a little bit, please, controller staff? Thanks. Okay, thank you for that explanation.
Now I want to spend some time on the new strategic asset allocation process. And why are we spending valuable sim time on the new strategic asset allocation process? I would argue that when you look at portfolio return attribution, you broadly divide it into two components. One is strategic asset allocation, one is manager selection. Broadly speaking, 90% of the return attribution comes from asset allocation. So it's one of the most important things we do, all of us in this room. So these are the four broad categories I'm going to spend time on. Let me update you on the strategic asset allocation process. What do we do? How do we do it? This one is consultant-driven in conjunction with BAM. Your consultants run a mean variance optimization on all your asset classes, a standard portfolio tool. And what drives that mean variance optimization are three key variables: expected return, expected volatility, and expected correlation of each asset class in comparisons to the others. These are 10-year projections, and just remember that these are projections, and they're subject to all sorts of variability and assumptions. The other thing that I would share is each of your consultants have very different capital markets assumptions, so just by that definition, you're going to end up with different portfolios. And the other thing I would share is each system has a different risk tolerance, different cash flows, different views on duration, different views on different asset classes. So with that in mind as well, you're going to have different strategic asset allocations. So let me talk about on the overview. It's important to set the backdrop for looking forward and just some stark realities of where we are. Longest expansion ever. Historically high asset returns over the last 10 years, and that's both compared to expectations and economic growth and historical returns. And then the other reality of record low interest rates. At the end, I'm going to talk about challenges and observations. So here's a slide on the longest economic expansion. This was as the end of August, and we have now, the economy has now eclipsed the recovery from 1991 to 01, so we are on the longest expansion in record. And as many of my BAM colleagues have heard me say over the years, expansions don't die of old age. They die of typically monetary policy tightness or some type of exogenous event. So the simple fact that we're the longest expansion on record is just a factoid. It has nothing to do with the future necessarily. The other observation on the second side of this slide, the right side of this slide, is the degree of the expansion that we've experienced. So those 7 squiggly lines all represent the 7 longest expansions on the left-hand side of that slide. And the percent number associated with each of those lines is the aggregate GDP growth during the time of that expansion. What's the takeaway from this one? While it's the longest economic expansion, it's been a very weak expansion. We've experienced only 25% GDP growth over the last 10 years, and you can see in comparison to other expansions how that GDP growth has undershot relative to other ones. And I would ask you to keep that in mind, that 25% GDP growth, because I'm going to refer back to that in a couple slides. Secondly, the actual returns of your portfolio, these are net returns by asset class, are listed here. And I would like you to look at those compared to what your consultants expected in 2016. The green signifies returns greater than the consultant's expectation. The red signifies returns less than. Returns across all these asset classes are positive. So the red does not mean negative. It just means it's under what the consultants expected. Observations here. The actual returns were pretty darn close to what your consultants recommended, so I think you all have good consultants. The second thing I just draw your attention to where returns have been higher or lower than expectations. And at first, U.S. equities, which I touched on earlier, you can see in 3- and 5-year numbers have vastly outperformed expectations. And then the underperformance in international equities, both EFI and EM. And what's really striking is the EM number over the last 5 years and how that has vastly underperformed expectations. The other two I would draw your attention to, real estate has outperformed, private equity has outperformed, and infrastructure have outperformed. And those are meaningful numbers. So this slide, a lot going on. So what this attempts to capture is the returns in a hypothetical global 60% equities, 40% fixed income portfolio. And each of those squiggly lines represent 10-year time periods. So what the red line shows you from that time period of 09 to 18, the returns on that hypothetical portfolio were the highest 10-year period over any other period over the last 50 years. And if you look about where that number shows on the right-hand scale, about 70% return over that period, compare that to what the GDP growth was in the expansion. As a reminder, that was 25%. So one of the realities of where we stand is to say it differently, markets have outperformed the economy by a lot. Here's another slide on that same theme. On the left-hand side of this slide shows returns in asset classes over the last 10 years. On the right-hand side is growth in various economic measures. Not necessarily apples to apples, but it highlights the massive outperformance in financial markets as compared to the economy. So let's talk about valuations, because I've hinted that we face very historically rich valuations. So we are at the lowest 30-year yield in history. As you can, this chart's a 10-year chart, and you can see that little on the far right-hand side. We're sub 2% at the end of August. We've since, risen in yield, so we're off that low, but we're still extraordinarily low for that 10-year period. Here's a slightly longer look at interest rates. So this goes back to the founding of our country. A lot of things have happened during that time period. Just as a reminder, the Great Depression in the 30s, World War II, our Civil War, and now we have lower yields than at any time in the history of the country. And as a reminder, in the Great Depression, in the early 30s, we had 10% deflation. It switched to inflation in the early part of the 30s and back to deflation in the late 30s. Unemployment rate, 25%. Where do we stand today? Unemployment rate of 3.7, inflation of 1.7. Begs the question, why are interest rates lower now than any time in the history of this country? I would offer two explanations. You've heard me preach about QE before. In aggregate, across the central banks, $12 trillion of QE over the last several years. And that has resulted in negative interest rates around the globe in some different places. Roughly 17 billion of negative interest rates, with 40% of that being in Japan, 60% of that being in Europe. And that pulls our interest rates down low as well. So long interest rates, investors kind of think about them as being fungible. So when interest rates around the globe go lower, they pull our interest rates lower as well. So that to me is the really strong contributing factor to why this is what it is. So what are the implications of low interest rates? By definition, the expected returns for long-duration treasuries have to be lower now than they were 3 years ago. The good news is interest rates are what we discount cash flows on any asset. When you think about how do analysts analyze a stock, they look at 30 years of expected cash flows, they discount them over some rate. What is that rate? It's some kind of long-term interest rate. So that long-term interest rate has been supportive of the rich valuations in most asset classes. The other implication would be the increased uncertainty over the stock-bond correlation going forward, particularly at this low level of interest rates, and particularly with what's going on with our budget deficit. Switching to expensiveness of U.S. equities. This is a chart from Goldman Sachs, and what this uses 7 different valuation models. It goes back almost 70 years, and it divides the valuation of the equity market into 10 different deciles, with the right-hand side being the most expensive, the left-hand side being the least expensive, and it also gives the actual returns for each one of those deciles over the next 5 years. So the red The red box highlights where we sit today. We are in the 9th most expensive decile on a historical basis. And when the equity market has been there, the U.S. equity market has been there, it has experienced 3% annualized returns over the next 5 years. That's what that blue bar signifies. That red dot shows the number of years when we've had positive returns, and that's slightly above 50%. So again, history doesn't repeat, it rhymes, and that's just where we are in terms of the U.S. equity market. What this slide shows with these 5 floating columns is, peels back the onion a little bit in the equity market. Quick explanation as to what each floating column represents. It is the 1-year forward price earnings ratio over the last 10 years. The high is on top of the bar, the low is on the bottom of the bar. On the right-hand side is the average over the last 10 years. On the left side of that floating column is where we sit as of, I think this was as of June 30. So you can see in the U.S., we are close to the top of that PE ratio. But when you peel that back a little bit, what you can see is large cap growth is at the high. Not surprised. These are the FANG stocks. They are expensive on a historical PE ratio. But when you look at value, the third floating column, we are right at the mean over the last 10 years. And when you look at the fourth floating column, that's international developed markets, again, at the average. And emerging markets were actually slightly below where we've been over the past 10 years. Implications of these valuations. Expected returns in U.S. equities, given the valuations, they have decreased going forward. And while large cap growth is historically rich, small cap and value are more reasonably valued. EFI and EM equities more reasonably valued. And the key question is, how are these valuations going to change in either interest rate direction? It's not just public markets that are expensive, private markets are expensive as well. This slide shows for private equity what the average EBITDA purchase multiple has been over a period of years. So 2 takeaways from here. If you go to the second to last column, I kind of discount the last column because it's for Q1 of 2019, and there's only 31 transactions in this graph as compared to multiple hundreds in the other. So the year 2019 is yet to be finished. So 2 takeaways from here is the gradual increase in purchase multiples since the global financial crisis. You can see a gradually higher number. And also where 2018 is comparison to 2005, 06, and 07, which was pre-crisis. And you can see, again, almost 20% higher. Real estate. The green line is the cap rate, which is very indicative of the annual return in yield you should expect in your core real estate market, core real estate portfolio, and you can see that is at or near a low as well. Again, this is a function of 10-year yields. Cap rates are some spread over 10-year yields, and the yellow line at the top is the average spread over the last 20 years. So we're at or about the average spread. So what's really driving cap rates down has been U.S. Treasury yields. So this slide I showed you earlier. What's new on this slide is the far right-hand column, and this one I think ties together the expensiveness of asset classes that I've been talking about. So this is the average. Again, your 5 consultants, we've averaged out their return expectations going forward for each of these asset classes. And you can see what that average is for each asset class. So 2 takeaways here is virtually every asset class has a lower expected return going forward. The second thing I would draw your attention to is only, 3 asset classes are above 7%. EM equities on terms of expectations. Private equity, am I missing one? And OFI. Those 3 asset classes account for 20% of of about 20% of your AUM. So the other 80% have a sub 7% expected return. And the other reality is those three asset classes are all basket assets. And as you know, we have to abide by the basket clause. It's New York State law, and that limits the amount of assets that can go into there by 25%. So let me tie all this together. What's the challenge that we all face in this room? And that is the appropriate strategic asset allocation given late economic cycle, expensive asset classes. We need to limit the portfolio volatility, the reality of the basket clause, reduce our portfolio drawdown risk, and achieve our 7% return over a long time horizon. On the volatility, the basket clause and the drawdown risk, Miles, in his comment, is going to spend some time on some of the realities of that. So the observations, it really gets down to the bottom line on this slide, is an increased probability of lower than 7% portfolio returns going forward. So that finishes mine. So let me see if there's any questions or observations on any of these slides.
Before we take questions or observations, can trustees who have come in since we did roll call identify yourselves for the record? No, it's not just you. Marika.
Good morning, Marika Scott McFadden, Deputy Bronx Borough President, here for Ruben Diaz Jr., Bronx Borough President.
Thank you. Elizabeth?
Elizabeth Guzman, here for Jumani Williams.
Susanna Vickers for Controller Scott Stringer. Jennifer Konovitz for Controller Scott Stringer.
Jennifer Konovitz for Controller Scott Stringer. Okay, speak up, folks. Anybody over here? No. Okay. Thanks. Questions for Mike Haddad? Aldrin, you have a question?
I know you'd like an opportunity to speak about the inverted yield curve, and I guess 3 reasons why we shouldn't care, or 3 reasons why we should care, depending on which side of the fence you want to opine on.
We should care. History would tell you that when 2s10s inverts, it has been a precursor to a recession going back over, since World War II. So it matters. The degree of the inversion and the length of time that curve has been inverted matters as well. That curve inverted for a couple days. It's now positive again. 5 basis points, but it is what it is. Why the signal is not strong this time has to do with the very low yields that we have in this country due to what I would argue is $12 trillion of QE, as well as negative interest rates around the globe. There's another measurement, this is getting in the weeds of bond minutia, called term premium. Term premium explains the increased yield you get for extending duration. That term premium is at an all-time low. So for increasing duration, so when you increase duration, it's supposed to be more risky. And if you take more risk, you expect to get compensated for that. We're not getting compensated. In the market today, one is not compensated for extended duration. So those couple factors make me at least less concerned about the signal from the yield curve than what it's done traditionally. So to tie that together, given the influence on from QE and negative yields, I would kind of think 2s10s would have to invert by something greater than we've had historically and for a longer period of time historically to get more concerned about a recession. And I think that's an important point, because if we are going to, so then it begs the question, so the economy's slowing, and is this just a mid-cycle pause, or are we going into recession? And 2 very different outcomes for markets. Mid-cycle pause, equity market does well. It has its ups and downs, but over time does well. If it's a recession, the equity market usually goes down. History would argue something like 12 to 15% during that recessionary time period. So yet to be resolved.
Other questions for Mike on his presentation? So I just have a couple. The first is the slide on the disparity between real economy performance and market, asset prices. It's slide 18, at least on my version. Yeah. That's really, that is so telling? I mean, I don't know what it's telling us. So what is it? It seems very telling, but what is it telling us? And what does it mean? You know, the question I have really is, so if there is a recession in the real economy, would you expect that you would have a similar disparity where asset prices would crash more than a real economy recession, or would asset prices continue to, be higher? In other words, like the way leverage maximizes upside but maximizes downside as well. What would you expect to happen if there were to be a recession with market performance?
So that begs the question: why did this happen?
Oh, okay. So why did it happen?
Low interest rates. When you take the discount rate from 5 to 2, all things being equal, the value of those cash flows goes up by a lot. So the drop in interest rates, to me, has been the primary reason for this disparity in returns in asset markets versus the real economy. So then it begs the question, if we go into recession, are we going to get the same magnitude of drop in interest rates this time around that we got last time around? Don't know. I would argue no.
Well, magnitude is impossible since they're so low already, right? I mean, there's not too much lower that it can go, a little bit.
Did we ever think German 10-year yields were going to be minus 50?
Right.
Negative interest rates could go that way.
It could go that way, and if we did that, if our 10-year note went from, I don't know where it is today, but to minus 50, that's a big move. In a call with Rokutan, we hypothetically walked in, we discussed if the 30-year dropped from 2 to 0, what kind of return is that? It's 47% return. I mean, it's a huge return. And that drop in rates would help immensely asset prices. Why, in my humble opinion, do I not think that's going to happen? There's not $12 trillion of debt to buy anymore. Japan's running out of bonds to buy. The ECB on Tuesday announced a new QE program. First of all, it was opposed by France, Germany, and Netherlands, who compose 50% of GDP in Europe. But by the rules of the ECB, votes aren't cast by GDP. Mm-hmm. It's a rotate. They don't even vote. But the fact that Malta was in favor of QE, and I think Estonia was in favor of it, Draghi was able to get it through. Huh. Draghi's done at the end of October, and Lagarde takes over. Different policymaker, so we'll see what's on her board. Fed decreased rates by 25 yesterday. Again, not a unanimous decision. So if you peel back the onion a little bit, they also include in a dot plot. The dot plot is each Fed voters' view on where interest rates will be at the end of 19, 20, 21, so on. So what's interesting about 19, 5 voters expected rates to be 25 basis points higher than they are today. 5 expect them to be here. 7 expected them to be lower. So what does that mean? That means 5 out of the 17 voters were against this increase. Against this decrease. That's 30%. 7 more one another. There's obviously dissension on that. How do they reconcile that? I'm not sure. But it just goes to the point that it's getting tougher to push rates down lower from where they are now. So to answer your question, if the economy does go into recession, I don't think we get the same drop in interest rates that we experienced from 08 to 19. So I would be concerned about asset prices. I don't know if I'd use the word crash, but I would be concerned.
Go ahead.
Yeah, I just had a question. Can you talk a little bit about the positive correlation between fixed income right now and in equities? Is this a temporary environment in your view, or does it have to really to do with the low interest rate environment that's driving up both bond prices and equity prices?
I think what's driven it has been extraordinarily accommodative monetary policy. So, not just here, but around the globe. And that's low or negative interest rates, policy rates, that's negative 10-year yields, that's global QE. So as the central banks ease, that helps bond prices, and that lower discount rate helps asset prices. So going forward, how is that correlation going to work? Are they going to be able to lower interest rates at the same time? I don't know. I don't know. And we have a lot of money in long duration treasuries, and it's not so much because we think a 220 yield is attractive going forward, but it's a diversification against left tail risks in the portfolio. So will those continue? It's a good question. Yeah. And
This is kind of uncharted, right?
Uncharted. It begs the question, are there other... So one of the commonalities from every consultant is the desire to reduce risk in the portfolio. Depending on which consultant, there's different degrees of magnitude. And the second is to get a little less, get less beta out of the portfolio, so less dependence upon the actual returns of the market, to get more idiosyncratic sources of alpha in the portfolio.
Thank you.
Other questions for Mike? Yes, Aldrin.
In the past, when we faced, let's say, 4 to the 5 last recessions, we went into them with interest rates above 5% or so. Rates being so low now at 2%, what other levers would we have if we hit that type of market correction with interest rates at 1.75 or 2%?
So our Fed Chair Powell was pretty clear on that yesterday. The exact same question. And the question was phrased as, will we see negative interest rates in the U.S.? And his answer was, they thought about it in 2009. They decided against it. Because of implications for the banking system, implications for the money market functionalities, and how that funds corporate America. The tools used then were forward guidance and massive quantitative easing, not negative interest rates. So his answer was, I think that same analysis holds. So it means monetary policy is kind of limited. The other big tool we have is fiscal policy. That's not under the control of the Fed, that's under the control of the government, and we don't really have a functioning government right now.
That would be fiscal policy, that would be austerity.
No, it'd be the opposite. It'd be expansion. Expansion. You know, and so the incoming ECB chair, Christine Lagarde, has been quite vocal on it and thinks that fiscal policy in Europe needs to be expanded to try and help the whole economy, and that really falls upon the Germans. And the Germans have, it's mandated in their constitution about running a budget surplus. So to get that change in their constitution is a big deal, and German history is what it is, and it's not something they're real keen to do. So there's a lot of obstruction to fiscal policy. So I think it would be the lever that will be pulled. So then it begs the question, what happens with fiscal policy? Yeah, more deficits, and that should push long interest rates higher, not lower. And then that kind of gets to this point. What happens if we get stronger growth, but maybe we get lower asset prices? So I think if going forward we get a recession, we get expansion of fiscal policy here, maybe Germany, maybe the Netherlands, this graph inverts. We get the real economy outperforming relative to this underperformance.
Other questions for Alex?
I'm Mike.
Sorry. Alex, I got you in the brain. Okay, great. Thanks, Mike. Okay, then Alex, I think you're next.
Well, thank you, John and Mike. And with that as backdrop, what I will say, you'll see you have just heard some of the conversations that BAM has been having with your consultants as we think about the new strategic asset allocation. And we expect that within the next couple of weeks, we call it early October, each of your consultants will begin to have very extensive dialogues with each of the boards, as well as we come to each consultant comes to a recommendation for your review and approval. So that is where we are with that process. So now stepping back, I will go through the fiscal year-end performance for 2019. So for the fiscal year ended June 30th. So beginning here with our overview slide on AUM. You see plan AUM for the fiscal year in the aggregate is at $207.9 billion, and then you see the breakdown by system. So you see each system AUM from $6.4 billion for BERS to $77.8 billion for teachers. So let's address performance in the fiscal year and for the second quarter. For the second quarter, as you can see from the third column to your left, the performance ranged from 3.32% for police to 3.57% for teachers. And in the fiscal year, returns were, again, 6.95% for police to 7.54% for teachers. We spent a little time trying to understand a little of the drivers of the difference in returns by system. And for simplicity's sake, I'll just stay with police versus teachers as kind of the bookends here. And if you look at what accounts for some of that difference between the performance of those two systems, it is primarily driven by manager value add or manager outperformance. So your managers across asset classes outperforming their benchmarks. Specifically, I would highlight 3 asset classes where, for instance, teachers managers, managers had outperformance that accounted for that 7.54%. First of all, U.S. equities was a standout. Actually, one of your active managers, where active managers in U.S. equities, Brown, which is a small cap growth manager, and on a relative basis, teachers has a higher allocation to that manager, had a very strong year. Again, accounting for that manager outperformance, which you see in your portfolio. I think another area where you saw differences was emerging markets, where you saw manager outperformance again, and actually PE was the third asset class where there was manager outperformance on a relative basis for teachers, leading to those results. I think what I would also comment on is if you look at emerging markets, let's step back to emerging markets, teachers outperformed police in this example. That was driven by the Chinese equity markets. So the Chinese equity markets, if you look at the benchmark indices, the custom indices, as you know, teachers does not have China, police does. China underperformed, for the fiscal year. So just the index returns, teachers was higher than police, and then teachers managers against their index also outperformed. So I think that led to that kind of differential of almost 60 basis points between police and teachers. Now, looking at, again, stepping back overall, I'm looking at the 1 year, but also more importantly, the 3 year. If you look at the 1 year, 3 of the 5 systems did exceed the discount rate, our 7% assumed rate of return. But more importantly, for the 3-year trailing period, as we focus on more longer term horizons, all systems are well ahead of the 7% assumed rate, and not only ahead of the 7% assumed rate, but also have beaten or exceeded the performance of an index portfolio, a 65 equities, 35% fixed income index portfolio, as you can see there in the far right-hand column, and in addition exceeded the performance of other large pension plans as measured by TUX. And as I always say, the TUX numbers that we show, or they report, I should say, are gross of fees. So here's the overall total portfolio performance for each system, and this is against each system's custom benchmark. So all systems slightly underperformed, as you can see in the far right-hand column, the under-over performance. You see all the bars are slightly negative. Underperformed for the fiscal year, the custom benchmark by system. And the horizontal line, once again, just represents the 7% discount rate, which 3 of the 5 systems exceeded in the portfolio. let's get a little granular on that. When we break down the components as to why there was some slight underperformance versus the benchmark, what you will see, and this, if you look at the middle column, it will tell you, it was largely driven by asset allocation versus manager underperformance. So asset allocation was the driver of slight underperformance versus the benchmark. And what was that simply was driven by, as you'll recall from the slides that Mike presented, it's the tilts in the portfolio, and primarily the underweight to U.S. equities was driving that slight underperformance, given that the equity markets, U.S. equity markets in particular, had a very strong performance in the fiscal year. So now let's go asset class by asset class. Beginning with U.S. equities, if you focus on the middle column, you'll see the performance by system versus your benchmark, and you will see that performance range from a positive 33 basis points for teachers to negative 74 basis points for fire. And a couple of commentary that I would make for teachers. Once again, Brown was a very strong performer for the fiscal year and a driver of that outperformance. I'll comment for NYSERS that Wellington actually added the most value, but some of that outperformance was actually mitigated by underperformance at research affiliates, both their large and both small and large cap. For police and fire, similar to NYSERS, research affiliates underperformed the most in the fiscal year, but the largest part of that underperformance was driven by Iridian, which you'll recall as a manager no longer in your portfolio as of June. And for BRRRR's, performance in the fiscal year in U.S. equities was essentially flat. So moving on to international developed EFI markets, you will see that performance ranged against the benchmark from 41 basis points positive for NYSERS to a negative 127 basis points for BRRRR's. Again, NYSERS, Walter Scott, drove performance in your portfolio for the fiscal year. For teachers, police, and fire, you have Causeway and Bailey Gifford actually underperformed in the fiscal year in EFI, and that was actually partially offset, only partially offset, because it was negative overall, by some strong performance from Walter Scott. In addition, I should mention that for Bailey's, in particular for police and fire, some of Bailey's out of benchmark holdings in China underperformed. So that's driving some of that performance that you see for police and fire. And for BRRRR's, that large underperformance that you see there in international developed was driven by Bailey. And I would mention that BRRRR's has kind of the fewest managers just relative to the other four systems in international developed markets. So any one manager actually has a large impact on overall results. So that's why you see that 127 basis points underperformance versus the benchmark. Now, turning to emerging markets, all systems, excluding BRRRR's, actually outperformed in emerging markets in the fiscal year. For teachers, NYSERS, police, and fire, the outperformance was actually Bailey's. So Bailey's in emerging markets did actually outperform for those four systems. And at NYSERS, police, and fire, some of that outperformance, I should mention, actually was mitigated by some underperformance at Acadian. And I mentioned that because at BRRRR's, Acadian, which is the sole active manager, underperformed and led to the negative 176 basis points versus the benchmark performance for the fiscal year. Now, turning to fixed income, the systems, as you see, all the middle column, all systems underperformed the benchmark for the fiscal year. And as was alluded to, and we've been explaining the last few quarters, and in the presentation today by Mike, that underperformance has been driven by the underweight to the duration target, as again, the long end of the curve has outperformed as yields have fallen across all maturities, I should say. That target duration gap has narrowed a bit, as you saw in the slide that Mike showed, quarter over quarter, but nonetheless, we're at anywhere from 70 to 80% of the duration target across the portfolio. Now, turning to high yield, the program had strong absolute net returns of 7.5% for the quarter, but that still lagged the benchmark for 4 of the 5 systems. Some of that underperformance that you see here was due to transitions that occurred in the fiscal year as a result of the high yield manager search. Most of those transitions occurred actually in the first half of the year. If you were to disaggregate the first half from the second half, you would see that in the second half, the managers generally outperformed the benchmark, but not enough to offset the underperformance in the first half. One commentary on teachers, since you see that the portfolio did have a 31 basis points outperformance versus the benchmark, is that they benefited from the relative overweight that you have to 2 very strong managers, Eaton Vance and Brigade. So bank loans as well underperformed. The index here for all systems, if you look at 2 managers that are responsible for, or actually say have the largest allocations in bank loans in your portfolios, Barings and Credit Suisse, both underperformed in the year, so that's driving some of that overall underperformance. I would highlight that for Fire and Burrs, Barings is actually 49% of the bank loan allocation, so that them underperforming certainly hurt the portfolio in the year. And for Burrs, sorry, I should say for Fire, I apologize, Barings is about 49% of the portfolio, but for Burrs, they're the sole bank loan manager. So again, that's what's driving the performance in bank loans, underperformance in bank loans. ETIs continues to do well, as we've been mentioning the last few quarters. So for the fiscal year, ETI has outperformed. This again has to do with the duration of the ETI portfolio. It's actually longer than that of the benchmark. So in a lower rate environment, you would expect your portfolio to outperform in ETI, given that difference or longer duration in our portfolio versus your portfolio versus the benchmark. Turning to hedge funds for police and fire, the overall portfolio outperformed the benchmark for the fiscal year and also generated positive returns. The next couple of slides will disaggregate the hedge fund performance between the 4 strategies that police and fire invest in and the tactical trade. So here we look at returns in hedge funds without the impact of the tactical trade. Again, the portfolio is outperforming in all periods. For the second quarter, for the fiscal year, for the 3 years, the portfolio is exceeding the benchmark and meaningfully exceeding the benchmark if you look at the bottom row. Now, what does account for the difference in overall returns, absolute returns between police and fire, is certainly that police returns are being negatively impacted by the performance of the fund of hedge fund portfolio. Now, the tactical trade. So the tactical trade outperformed the benchmark in the second quarter, but it did trail the benchmark for the fiscal year. If you look at the fiscal year results where we're trailing, the numbers themselves were not surprising to the hedge fund team or to BAM, given that the tactical trade itself was a defensive move to rebalance out of U.S. equity. So we would expect for it to underperform when the markets have rallied, which they have done. But I would mention that if you look at 3 of the 4 managers that were allocated capital in the tactical trade, they actually have positive returns. It's actually one manager, AlphaQuest, that has underperformed and has produced negative returns in the fiscal year. But I would note for AlphaQuest that in the second quarter, they had a very strong second quarter. So let's move on to private markets, beginning with OFI. So we have OFI here, returns. These are since inception returns through the second quarter of 2019. As you'll see, OFI is slightly below the benchmark. As you can see, the benchmark with the 300 basis points illiquidity premium to the index, to the public market equivalent, as it's shown on this slide. gains and losses in the OFI portfolio are really driven by idiosyncratic changes and performance of your managers. But what we would comment is that looking at the portfolio, some of the investments made in more stressed securities that actually became further stressed, distressed securities, I should say, that became further stressed in the quarter and were in the fiscal year and converted to equity, underperformed the benchmark, and that leads to some of the underperformance that we witnessed in the portfolio for the fiscal year. PE since inception performance. Again, I'll mention here that PE, as in real estate and infrastructure, is reported on a lag. So we're looking at performance through the first quarter of 2019. All systems, with the exception of NYSERS, outperformed the public market equivalent, or the PME, which is the Russell 3000. However, the system's returns, overall returns, continue to lag the PME benchmark, which is the Russell 3000 plus a 300 basis points illiquidity premium. Again, as we know, given the returns of legacy investments in the portfolio. That being said, I would just highlight that the portfolio continues to perform strongly. If you just compare fourth quarter returns in PE to first quarter of 19, we saw quarter-over-quarter improvement, actually about 10 basis points. If I give you a range as to what that means in absolute returns, the returns will range anywhere from 9.8% since inception for NYSERS to 11.8% for BRRRR in your PE portfolio, so strong absolute returns. That being said, you'll recall that in the fourth quarter, we had the large drop in the equity markets and a very strong rebound in the first quarter. So actually, the market rebounded more strongly than your valuations in the PE portfolio. You'll remember this chart which we use to just show trends in the PE portfolio, and here you can just better appreciate some of the positive trends that we see in the portfolio, particularly since the 2011 vintage, as we've been looking at. And once again, the y-axis measures the spread of or percent outperformance or underperformance versus the public markets. Once again, the pre-2011 vintages to the far left continue to trail overall market returns, but post-2011, we continue to witness strong outperformance. If you look at the 2011 through 2016 vintages, which are vintages with meaningful return data, that grouping is outperforming the public markets in aggregate by about 4.4%, and that exceeds the benchmark, which is the public markets plus a 300 basis points illiquidity premium. So we've seen strong performance, since 2011 in the PE portfolio. Moving on to real estate, we start with core. Core real estate performance since inception through the first quarter. All investments, as you can see here, are exceeding the benchmark. Just mention here, as you can see, that the benchmark for core real estate is a blend of 60% the Barclays Agg to 40% the Russell 3000. And as I always mention, some of the differences in performance by system have to do with pacing and manager selection, commitment sizing, and market timing. Opportunistic, non-core real estate. You see performance here as well has exceeded the benchmark for all systems. What I would,
I think you got the charts are exactly the same for core and non-core, so I think you got them. One of them's got to be wrong.
Yep, there's an error there. I think you're right. We'll correct that. So there's an error there. But if you look at the results of the non-core real estate portfolio, they have exceeded the PME, and some of the underperformance that you see for the systems excluding BRRRR, or some of the difference certainly has to do with some legacy investments, as we have discussed in the past. Same analysis that we continue to show every quarter on the performance by vintage year. If you look at the performance pre-2011, You will see underperformance generally for all systems excluding teachers versus the public markets. But post 2011, again, in all vintages for all systems are either first or second quartile in the non-core real estate portfolio. And last but certainly not least, we have infrastructure. Infrastructure portfolio, as you can see here, continues to be performing very strongly. The portfolio today stands at around 45% funded. It's diversified across about 125 portfolio companies located predominantly in North America and Europe. From a sector perspective, your largest exposures that you have are going to be the transportation, about a third, slightly under a third of the portfolio, 28%. Renewables, also about 28% of the portfolio, and midstream, 17%. And again, some of the minor difference that you'll see across systems has to do with the impact of some opt-outs for some systems in some underlying investments in certain fund managers. And then lastly, our vintage year analyses for infrastructure, kind of the same story here with infrastructure continuing to strongly outperform. You'll remember you've had some strong early realizations from some of your managers in infrastructure that's leading to that outperformance that you see, and some of the more mature funds in your infrastructure portfolio continue to perform strongly. So on a mark-to-market basis, they're doing very well, and that's what you see reflected here. So with that, we'll take any questions.
Questions for Alex about the quarterly performance reporting. Mr. Garrido.
Good morning, Mr. Chair.
Facilitator, please.
Oh. Good morning, Mr. Facilitator.
Good morning, Mr.
I'll remember that. Good morning, everybody.
Good morning.
Alex, I have a question about a little over a year ago. The mayor of the city of New York and the controller and a few of us as trustees sat and announced the divestment from fossil fuel and the redoubling of investment into green renewable energy. Where are we with the reinvestment as far as an allocation is concerned? Where are we with wind? Where are we with solar? Where are we, period? Where are we?
So a couple of comments on that. If you recall going back, and I don't have the specific numbers, Henry, going back to the announcement that was made, at around the time of the announcement, we estimated about $2 billion of exposure in the portfolio to climate solutions-oriented investments. While I don't have the exact numbers today, there's been certainly an increase since that time, so since that announcement, in terms of our exposure to those types of investments. I would say secondarily and importantly that the teams, all of the asset classes, have been working not only with each of your consultants, but also amongst themselves, looking, speaking to peer portfolio plans, speaking to other managers to source other potential investments that could be attractive to the portfolio. So those are at various stages of being reviewed and studied, and could be potential recommendations that could be brought forward to the boards in the future to have more investments in more climate-oriented types of investments. As you saw me mention, a lot of the exposure that you get to more climate-friendly investments are going to be in real assets. So if you look at real estate, so think about green buildings, et cetera, LEED certified and Energy Star certified buildings is where we have a lot of our exposure. And we're continuing to also work with your managers to get that data, because it's not just easily available. We kind of have to go asset by asset, or your managers have to do that. So we're sourcing that, but we are seeing increases. I think what I would also mention, since you mentioned just the divestment study, I think there will be an update later on today as to where that process is moving. You'll remember an RFP was issued, so that's part of your update today. There's a memo that was circulated with the results of the evaluation committee with regards to selecting a consultant to evaluate to develop whether it's a prudent strategy or whether it's prudent to divest from fossil fuels. So that is moving forward, and not to steal that theme's thunder, but we would expect that, that before the end of the year, after you've made your selection, the boards that are looking at that or have made their selection, we will have a consultant on board to study the potential to divest from fossil fuels.
Sorry, just to follow up. Now we stand in the issue of divestment. As I recall, the announcement was that we would double the investments from $2 billion to $4 billion. Now here we are, about 19 months into this process, and from all accounts that I can see, we're not even halfway there. So I appreciate what you're saying, but if we were serious about the commitment we made, and for those trustees who did that, I would think that we would be getting a more serious update about our investment into these asset allocations, and particularly on the issue on the climate solutions. So I would ask that we get a real update with numbers about where we are from the $2 billion to the $4 billion, and whether in fact we are on target or on pace to meet what we said we would do. And if not, then we need to reissue a statement or reissue our adjust our expectations, because some of us are getting increasingly frustrated about a number of press conferences that lead to nothing in terms of results. Thank you.
So we'll come back and update the numbers through the second quarter as to where we are and our exposure to those types of assets.
Alex, Joe Alejandro. I just want to be clear, and I understand Henry's concern for his fund, but I'm also concerned sometimes on these press conferences. I know police decided we were not going to be part of that. It seems like this seems like a whole universal thing when these announcements are made, that all the funds agreed. So I just want to be clear that it should be at least addressed in future press releases, whatever, that not all funds were involved with regards to the divestment issue of fossil fuels.
No, that's fine.
Mr. Chair?
Understood.
Mr. Facilitator, I have a second question, if you don't.
Henry, yeah.
The second question is in regards to fees, and the fees, many of the comments we do. A few years ago, we had a comment about how we were going to approach fees by many of these investment managers. Where are we with the assessment since the controllers review the fees in terms of where it was going? And where are we with some of the changes that we made to try to lower the fees for some of the investment managers in the past meetings?
Well, Henry, I would say certainly fees is something that we're focused on with every single investment recommendation that we bring before you. I think you kind of see that come to life in action in every potential investment that you see. I can't think of either a procurement on the public side, whether it's fixed income or public equities, where fees is not addressed, and we've been lowering fees meaningfully. And certainly in the private markets, we've been seeing that consistently, with driving down fees overall with regards to scaling or leveraging, I would say, the power of the 5 systems in terms of size to get the best discounts, and also being innovative with regards to investing in fee advantage strategies, co-investments in particular. So I think an investment today that you will see later on also has a no fee, no carry co-investment sidecar. Lastly, I would say, I think it was in late 2015, early 2016, we embarked on a process with managers on transparency around fees, to be very clear, requiring ILPA statements, particularly from your primary managers, those managers who we're continuing to invest in, because it's difficult in the private markets to get that information, particularly from those that you're no longer planning to transact with. And so certainly, we are getting that information. Our ability to see data is much more enhanced and enriched than it's ever been. Part of what we're doing from our operations side is developing also the ability to process all that information, and that's still in process, but certainly getting closer. But overall, fees, Henry, is something we continue to focus on, and I think you really do see it in all the investment recommendations we bring forth.
Again, I appreciate it. I think some of us were extremely disturbed by the analysis the controller performed that show in some asset allocations, 92% of the fees were eating away the returns in that order. I would ask that given your new philosophy to lower fees across all asset allocation, that the trustees receive an update where we are since that order was performed to figure out whether in fact the totality of the fees have been lowered, have been consistent, or have been increased since your new strategy has been since that order was performed. I ask that if it's possible you can provide that to us so we can read it. Thank you.
And I'll just say, you know, what I'm taking from this, Henry, and I think it's very helpful and instructive, is, you know, to come back to trustees with more specifics to some of the topics that we've been discussing. Instead of just giving a voluminous amount of information, maybe we need to come back with a little more pointed update to call your attention, because a lot of this information is in these reports, but we're going to make it more clear and we're going to make it more digestible and really highlight it and come back to you with the responses you've requested.
Other questions for Alex? Okay. Thank you, Alex.
Thank you.
I think we have another public session
risk.
report.
Yes.
Mr. Draycott.
Sorry, gotta turn on the mic. Hello? Okay, good.
Go for it.
So I want to talk about three things today. We're going to once again look at the macro factor risk report, second quarter blue box reports for one of the systems. I also want to revisit some of the stress tests we looked at approximately 6 months ago. I forget exactly when, but they were stress tests designed to analyze the possible impact of, or the evolution of the trade war with, or dispute with China. We also took a look at how different Brexit scenarios could impact the value of the system's holdings, so we're going to revisit those. We're also going to talk briefly about some of the difficulties, Mike alluded to this, some of the difficulties faced by the strategic asset allocation discussions. Again, following up on something Mike said, I'm going to remind everybody we had a pretty buoyant second quarter in equities. We had the S&P actually hitting an all-time high. This is in the aftermath of the Fed hinting that a rate reduction was in the cards. It held in at that level for the rest of the quarter and closed at, I think it was the best performing first half in something like 22 years. So despite the continued, somewhat gradual rise in the equity markets, the president managed to inject quite a bit of excitement into the picture by, on two different occasions, tweeting about increasing tariffs. In the first instance, it was tariffs on imports from China. You can see the arrows that we've put on the chart here indicate it's the day on which the president issued the tweet. The blue line is the Russell 3000. The yellow line is something called the VIX. The VIX is basically a futures contract that moves based on volatility of the equity markets. So you can see from this chart that on the day that the tweets indicated tariffs were going to be imposed, the market dived and volatility spiked pretty significantly. So anyway, that's important because on the next page, where we look at this is the only page we're going to look at in the blue box reports today. I'm again going to remind you, this is the arrow on the extreme right, that 87% of the risk in the investment portfolios of the systems comes from the equity factor. So the other thing I want to draw your attention to on this page is that though the chart on the previous page, which suggested realized equity volatility was probably slightly up, the volatility of the portfolio, anticipated portfolio volatility, actually declined very slightly. I think it was roughly a 12 basis point decline in calculated portfolio volatility. Though it was a decline, a small decline, volatility is still extremely high relative to the last 2 or 3 years. It's off slightly in the quarter, but still high relative to at any point over the last 2 or 3 years. The other thing I want to draw your attention to is something in the risk report which corroborates one of the comments Mike made. Our active exposure to the interest rate factor declined fairly significantly. That's a result of our increasing the sensitivity of the fixed income portfolio to interest rates. That was another way of saying that is that we increased the duration of that portfolio. It was by a relatively small amount, but it did bring us much closer to the benchmark in terms of the exposure to the interest rate factor. So on this page, I'm going to summarize or repeat some of the observations, or look at what the observations you could make by comparing the last quarter's macro factor report to this quarter's. That total change in portfolio risk of -2%, again, that's roughly 12 basis points, not a big deal particularly. The change in exposures to macro factors are summarized in the box below, the most significant of which is the reduction in the exposure to credit. Credit exposure is calculated by looking at what's called it's an analogy to the DV01, it's called CS01, it's the sensitivity of the system's fixed income investments to credit spreads. So that changed, decreased fairly materially. The other major change in exposure occurred in the interest rate exposure to the interest rate factor, and as mentioned previously, we did increase the system's exposure to interest rates, which had the impact of bringing us closer to the benchmark, i.e., reducing active risk to interest rates. Oh, in this page, I'm going to attempt a sort of an intuitive explanation of the change in anticipated volatility. As I mentioned, that was pretty small, 12 basis points. It turns out the lion's share of that, well, the things that contribute, the parameters that contribute to portfolio vol are exposure, factor exposure, factor volatility, and the correlation of the factors to the portfolio. So this is an attempt to attribute the change in portfolio vol to those parameters. And as you can see, the exposures didn't change much. Frankly, volatility didn't change much of the factors themselves. What did change is the assumed correlation between the factors. I go into more detail in this attribution in the page in the appendix. The bottom line is that most of the change in correlation came from industry sector correlations, and the major changes there were to the assumed correlation between healthcare in the portfolio, energy in the portfolio, and telecoms. There's also more detail on this page in the appendix if people want to get into it. In summary, what this is we not only redid the stress tests, these two series of stress tests, I think improved the analysis fairly significantly. This was done in conjunction with MSCI. It is not a work product of theirs, i.e. Something they publish broadly. They're assumptions that we've come up with, or stresses we've come up with following conversations with them. So the first thing that we did was look at a policy paper, a working paper published by the IMF, in which they talk about 3 different trade scenarios. They detail in this paper sort of a complicated model that estimates changes in global trade. And then those changes are input into a model that MSCI maintains, and that maps those changes to changes in market perturbations. So the first scenario is basically an all-out trade war scenario. So that assumes Trump comes out and says 25% on everything from China. The U.S. China responds and says, okay, 25% on everything from America. That would be pretty cataclysmic. It would these are models on top of models. So we've got to be careful with putting too much store in them. But that would call for almost an 8% decline in the value of the system's investments. The next scenario we looked at was a sort of a more measured trade disagreement, if you will. It imagines sort of somewhat coordinated reciprocal set of tariffs. Trump says 25% on autos and auto parts. China says the same thing, but we allow them to levy tariffs on some other thing to bring the total amount of tariffs up to parity. Obviously, China imports fewer automobiles and auto parts from the U.S. than we do from China. So this is nearly as devastating, or almost a 7% decline in the value of the system's investments. And then the third scenario we looked at was, probably absurdly benign. We imagine that China almost does everything that Trump demands. In particular, they put in place policies to encourage the purchase of American goods, and they simultaneously put in place export tariffs on the export of Chinese goods to America. So those are those scenarios. Again, there's more detail on how we came up with the shocks in the appendix. The other couple of scenarios that are of interest weren't based on any sort of policy paper. They were just arrived at through discussions with MSCI. We imagined what the impact of a no-deal Brexit would be, a crash out, about 3% decline. Again, estimates, very rough estimates. And then we looked at a benign Brexit, i.e. one which would allow the UK to continue to trade with Europe, much as they have historically, or recently, in the last decade or so. Sort of imagine that equating to a status akin to that of Norway, and in that sense, the market, in that scenario, the market would actually, the value of the investments would actually increase by about a percent. So the next thing we wanted to, I mentioned 3 topics. The last of them is this sort of following in on some of the comments Mike made. It's a quick look at some of the challenges faced by our ongoing discussions about the strategic asset allocation exercise with your consultants. And this is, forgive me, this is a very simplistic. I just want to set the table with a very overly simplistic hypothetical portfolio. So if we imagine we're looking at a portfolio that's required to achieve 7%, we make a very simplifying assumption. We say it's going to be 2/3 invested in equities, 1/3 invested in fixed income. And then we look at what we come up with a yield expected return on the fixed income. In this very, very simple analysis, I assume 250 basis points. That, by the way, corresponds to almost exactly the weighted average yield of the fixed income investments owned by the 5 New York City pension systems. We looked at that on Wednesday, and based on Tuesday's close, the weighted average yield on the fixed income investments owned by the systems was about 253. So we're right on top of the yield on the securities that these systems own. So just middle school math tells you that would require an equity return of 9.25 in order to hit a portfolio return of 7%. And the point of going through that exercise, and I know it's very simple, and this is a hypothetical portfolio, is just to compare it to the average equity return that your consultants have projected. Okay, and that's roughly 650. So in order to hit 9%, you have to hit an equity return almost 270 basis points higher than that which your consultants are projecting. I think the other set, there's 2 other sort of challenges I want to touch on very briefly. And the one is we talk about, everybody throws around mean variance optimization, which is central to the whole asset allocation exercise. The thing that I want to focus on is that this idea of an efficient frontier, which results from the consultant's asset return expectations, is that's not really the world that the pension systems in New York live in. What we've done here is this is roughly the median of the consultant's return expectations, and we've graphed the efficient. The risk team's put together a mean variance optimization framework that's capable of, akin to what your consultants use, capable of incorporating fairly complicated constraints like the basket clause. And what you're looking at is a graph that this spits out. And the red line is just the unconstrained efficient frontier. So just take the consultant's expectations, let the model go to work. The yellow line is actually the efficient frontier if we assume that the system's investments are constrained by the basket clause. So it tapers off to the right. It's no longer, like this nice smooth line up and to the right. And then the green line is actually the if you will, the space in which the systems actually live. So there's an additional set of constraints that are discussed with your consultants and imposed in their optimizations. And these are mins and maxes on each of the illiquid asset classes. So the idea here is only, you can't have the model allocating too much to an asset class we can't accumulate quickly or enough of. So in that instance, think private real estate, think infra. The other constraint is in certain asset classes where selling them would be expensive because the bid offer is pretty wide. We don't want the allocation to fall below a minimum. And an example of that would be, although the return expectations are very high, an example of that would be private equity. So there you have it. The interesting thing about the graph, well, there's two interesting things. One is, given the assumptions used, I don't think it's even possible to hit 7% on that green line. And then the other comment I'd like to make just on this page is there's a financial statistic called the Sharpe ratio, which is a measure of risk-adjusted return. And in the current market, and given the constraints that the systems face, the Sharpe ratio actually falls off as you move farther and farther to the right in the efficient frontier. So that's a simplistic way of saying just as you reach for return, the risk-adjusted returns are going to decline. That's it.
Questions for Miles on his presentation? Okay, thank you, Miles.
Okay. Now, I think you also want to hear a little bit about excluded companies.
Yes, sir.
Oh, sorry, and these are the slides I mentioned in the appendix if anyone wants to look at how we came up with that stuff. So moving on to excluded companies, you've all been distributed a memo on how we come up with the excluded companies list. Today, I'm really just here to answer any questions if there are. We generate it once a year at the end of the fiscal year. We understand the various memos that were rewritten a couple years ago. We understand them to prohibit investment in equity securities issued by companies that derive more than a specified percentage of their revenues from the practice identified in the memo. I wanted to make an important
Miles,
point here.
Just one question.
Sure.
So I just want to.
I'm sorry. Yeah, Joe. Yeah, I should look here this way occasionally.
Yeah. I just want to make sure that I looked through this chart, not chart, but page here. I want to make sure that I'm clear. So the risk team only takes action with regards to divestment resolutions passed by each particular board.
Yeah, that's exactly right, Joe.
It takes no other action on its own,
Correct.
adding or subtracting anyone on this list. It has to be by action.
And we look at the list once a year. We do it using analytics we've made you familiar with. But it's very much system by system per the resolutions that you have authorized.
Okay. And I think our consultant did not get some of the data for this. Is that correct?
We didn't see it until this morning.
They didn't get it until this morning. So if we could be a little bit more timely with that, or you can discuss that with our
Absolutely.
consultant.
Yeah. Sorry. That I don't know. why that- Sure. Our intention is really is. I know.
It's not an actionable issue right now for us. Anyway.
We're trying to be as transparent with this process as possible, and that's why, in fact, the whole notion that we, rather than make this a Bamagram, here it is at a sim. This is the list. Any problems? Let us know.
Yeah, and I can talk to Wilshire because I believe it was in the packet that was circulated previously. But if we have problems accessing that information, just let us know and we can work on the technology side of things.
So,
and now that you spoke up, and it deals a little with risk, there was an issue I brought up about 2 months ago regarding an investment, Susanna. You were going to get back to us regarding, there was one investment that was brought up with regards to not investing in a particular company as a result of a divestment by other boards, but we did not partake in that divestment.
Right.
And you were going to get back to us as to how to avoid that in the future.
Yes.
So if you could get back
Yeah, absolutely.
Right.
And just so you know, we've had conversations with OGC and the appropriate asset class head, and we'll come back to you very soon with the information that's been discussed for your for your review.
If you can also, remind the boards later, maybe during the break or whatever, as to what the issue was. That would be
Absolutely.
helpful. Thank you.
An important point I wanted to make on this page, which we may not have made with regard to the excluded companies list before, is I have a lot of confidence in the process that's in place to come up with a list of issuers of equity that should be excluded per the resolutions passed by the trustees. I cannot be nearly as confident in saying that we have identified every debt. We can't be confident saying we've identified every debt security issued by, every publicly traded debt security issued by a company that violates the revenue threshold set in the board memos. What that is, all that's saying is that there are some private companies that issue debt, and we don't know what their revenues are or what percentage of the revenues come from the obnoxious activity. In the case of debt, there's also instances where the debt isn't issued by the parent. It's issued by a subsidiary which has a different name. It's just harder to make a categoric statement. We've nailed every piece of debt issued by a company, which is publicly traded, issued by a company engaged in a practice the boards don't approve of. So I just want you to regard our efforts on the debt side as best efforts. I'm very confident about us identifying securities issued by equity securities issued by companies engaged in obnoxious practices. Anyway, spending a lot of time on this is probably too much. The final thing we do is we compare. We look at the impact of the exclusion. We want to keep that in front of the trustees. What is the tracking error as a result of this particular exclusion, and what is the cumulative tracking error of all of the exclusions? We do that by basically looking at the system's benchmarks, basically without the exclusions, imagining there are no exclusions, and then we look at that particular exclusion, and then we calculate the tracking error between the two portfolios. And then again, we also keep track of what the cumulative impact of all the exclusions are on that system.
Question, yes, Mr. Bonilla.
On looking at the matrix in terms of the exclusions, is percent revenue the only indicator by which this decision can be done? Because I can think of several scenarios and instances where market share and other indicators will probably be preferable and more in line with the spirit of the resolutions to begin with.
We will take whatever direction the trustees want to give us. The resolutions, as they're written, call for us to exclude companies whose revenues exceed a specified percentage. You obviously have the ability to change that directive to us. We would just ask that you be quite specific.
But to follow up, Miles, if the trustees were to specify by market share, for example, is that something that you have the ability to calculate?
I'd like to come back to you on that, but yeah, quite possibly.
Okay.
You're touching on a point. I want this to be as non-subjective by BAM as possible.
Right.
So I want it just to be, we look to the data we've licensed, we do what the boards have instructed us to do, here's the list.
Right. I mean, you could anticipate a situation, for example, where a company's revenue from a particular service or product is less than the threshold, but because they're the biggest company in that space, they control 95% of the market. And we probably, in the spirit of the resolution, as Aldrin said, would probably still want to exclude that company from our
So there's two ways to skin that cat, right? We could do what's been suggested, or we could just do some analysis, inform you of that fact, or you could request us to do some analysis, and you adjust the revenue threshold.
Right, and I think, the point that Miles made is an important one. BAM cannot be subjective and come up with, additional analyses to do just because they might make sense. We're going to do what the boards instruct us to do, and, if for BAM to function properly, the boards just need to be specific with the instructions that they give their investment advisor.
I think what I would add, just Susanna, as Miles mentioned, that depending on the instruction, give us some time to research our ability to track that information, because the best way for us to do it and then instruct your managers accordingly is if we have a data source that can reliably get that information for us, so we can develop those lists.
Right, that was really what my question
Yes.
was, is that, can you obtain that data? And so it looks like Miles is going to look into
Revenues
it.
Yeah, and I
What's that?
Revenues is in the easier.
I know, but revenues may not, revenue percentage may not capture.
Market share is difficult, but we would have to look into if there are any data sources that could reliably get us that information.
Right, and
I
one
just don't
question
wanna
is whether the
promise
existing
us.
data source has that information or not. So,
We'll take a look. I
Yeah,
I
take a
think
look.
it might, actually,
Okay.
but I'll confirm it to
Aldrin?
I mean, just to amplify that point, I mean, in terms of the data sources, there's some, these companies and they have industries and they have associations, and it just may very well be that an industry, an associational leader in that industry, which is reflective of the kind of percentage market, exposure they have in that, is some, a company that might have a lot of headline exposure, a lot of headline risk, a lot of different, but as a percent of their revenue, it's under the threshold that we've set. So this is a situation where, in terms of the spirit of what the trustees initially, in terms of the risk aspect of it, the market aspect of it will be very important.
Yeah, so I think it could be probably an iterative, a conversation. Like you're thinking that it should be more than just threshold percentage of revenues. We can take a look at what's available, come back to you, and do any of these data points work?
Okay, all right, we will continue this discussion. Any further questions for Miles about the excluded companies process? Great, okay, thank you, Miles.
Okay.
Anything else for public session? All right, so we're now going to entertain motions at each board to enter executive session. I'll go in reverse order. Is there a motion at NYSERS to enter executive session?
So moved.
Thank you, Mr. Bonilla. Is there a second?
Second.
Thank you, Mr. Katzman. Any discussion? All in favor of the motion to exit public session and enter executive session at NYSERS, please say aye. All opposed, please say nay. Any abstentions? Motion carries. At Teachers, is there a motion to exit public session and enter executive session?
So moved.
Thank you, Ms. Penny. Is there a second?
Second.
Thank you, Mr. Brown. Any discussion? All in favor of the motion at Teachers to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. At Police, is there a motion to exit public session and enter executive session?
Motion to go into executive session.
Thank you. Is there a second? Thank you, Mr. Borelli. That was Officer Alejandro who made the first motion. Any discussion? All in favor of the motion at Police to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. And at Fire, is there a motion to exit public session and enter executive session?
So moved.
Thank you, Mr. McGinnis. Is there a second?
Second.
Thank you, Mr. Kelty. Any discussion? All in favor of the motion to exit public session and enter executive session at Fire, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. So we are now in executive session at all the boards. I would ask the cameras to be turned off and...
In executive session, we received and discussed an attribution analysis of our returns. We received and discussed a memo on a fiduciary issue. We will receive an updated excluded company list. We heard and discussed a presentation on a real estate investment. Consensus was reached, which will be announced at the appropriate time. We heard and discussed a presentation on a private equity investment. A consensus was reached, which will be announced at the appropriate time. We received and discussed certain investment policy statements. Was reached on one change. We received and discussed a presentation on our MWBE program. Consensus was reached, which will be announced at the appropriate time. We received and discussed a recommendation on a domestic equity manager. We discussed various recommendations that were made at July's SIM. Period.
Thank you, Susan. With that, can I have a motion to adjourn?
So moved.
Mr. Brown, second.
Second.
Ms. Vickers? We are adjourned.
VSB. So moved.
Second.
Now, go. So the board is, may I have a roll call, Mr. Executive?
Yes, Madam Chair. For the firefighters, UFA VSF, for Mayor de Blasio,
Cynthia Collins.
for Controller Scott Stringer,
Jennifer Collins.
and for Commissioner of Finance Jacques Sheehan.
Cynthia Collins.
For the UFA, Mr. Leroy McGinnis. Present. Mr. Edward Brown.
Present.
We have a quorum.
Thank you. The board is requested to note the receipt of quarterly reports.
So noted.
The board is requested to make a motion to adjourn the FFVSF meeting and to go into the FOBSF meeting.
So moved.
Second. Roll call, Mr. Executive Director.
Okay, for the UFOA Variable Supplement Fund. For the Mayor of New York, Mayor de Blasio.
Cynthia Collins.
For Controller Scott Stringer.
Jennifer Collins.
For Commissioner of Finance Jacques Sheehan.
Cynthia Collins.
And for the UFOA, Mr. Jack Kelty. Present. And Mr. William Guilfoyle. Present. We have a quorum.
Thank you. The board is requested to note the receipt of quarterly reports, of the quarterly reports.
So moved.
Thank you. May I have a motion to adjourn the meeting and to move back into the fire pension fund?
Motion to adjourn. Jack Kelty.
So during the executive session, the board discussed various investment matters and personnel matters. We now need a motion to adjourn.
Motion to adjourn, William Guilfoyle.
Second, Eddie Brown.
Thank you. Meeting adjourned.
Ready? Okay, during the executive session, the trustees heard from BAM, their consultants, and several managers regarding the following asset classes: real estate, private equity, public equity. Decisions were made. Those decisions will be made public at the appropriate time. In addition, the trustees made a decision regarding previous unfinished business in the following area: hedge funds. Other matters were tabled.
So at this time,
Hold on. Nope.
oh, sorry.
Not done yet.
Oh, easy now.
The trustees tabled discussions regarding their private equity program, infrastructure program, real estate program, and MWBE program.
With that, I'd like to make a motion to adjourn.
Second.
Motion's adjourned.
Great. We're back in public session. Melanie, could you please report out of executive session? Mic on. Mic on.
The board approved an addition to the excluded companies list, the details of which will be disclosed at a later date. The board agreed to commit funds to a real estate investment, the details of which will be disclosed at a later date. The board agreed to commit funds to a private equity fund, the details of which will be disclosed at a later date. The board agreed to amend investment policy statements for private equity, infrastructure, and real estate programs. The board agreed to expand the MWDVBE brokerage firms, the details of which will be disclosed at a later date. The board agreed to terminate a public equity investment, the details of which will be disclosed at a later date. The board took an action on a contractual matter, the details of which will be disclosed at a later date. The board agreed to increase potential commitments to emerging manager programs, the details of which will be disclosed at a later date.
Thank you, Melanie. That concludes our business for today. Is there a motion to adjourn? Is there a second? Thank you. Any discussion? All in favor of the motion to adjourn, please say aye. Opposed, please say nay. Abstentions? The meeting is adjourned. Thank you.